Let's start with where we are right now. U.S. upstream oil and gas is in a moment that's quieter than the headlines might suggest, but the signals underneath are profound. After 2 years of historic consolidation, think ExxonMobil buying Pioneer, Chevron acquiring Hess, and a record $192 billion in deals in 2023, now M&A activity has cooled dramatically. In the first quarter of this year, we're down to $17 billion in new deals. Rig activity is also at a low point. As of June 6th, the lowest since 2021. Oil rigs are down, gas rigs are up just a bit, and companies are laser focused on operational efficiency and shareholder returns instead of chasing production growth. Prices reflect this mood. WTI crude is holding at $65.33 a barrel, and Henry Hub gas is at $3.64 per MMBTU yesterday afternoon. These are not bad. I mean, they're survivable numbers for many of us, but not the kind of prices that get conventional oil men excited. In fact, earlier this year, Chris Wright, who's now Secretary of Energy, hinted that $60 seemed like, to him, a price that would let his peers in the shale business survive. Most old school operators working conventional reservoirs aren't thrilled about $60 oil, but they do take some comfort in the sense that this probably indicates that there's a floor and it may not fall much lower. But there's some real disappointment. It's not running at $80 or higher where more conventional projects become truly viable. To understand how we got here, let's take a look at the bigger picture. Over the past 60 years, 60, that's a little ways back, huh? But over the past 60 years, the U.S. upstream sector has been shaped by a series of major shifts. In the 60s and 70s, we saw a surge in offshore exploration, especially in the Gulf of Mexico, thanks to federal leasing and policy support. Then by the 1980s, offshore was a major piece of the pie. And then came a long decline in conventional oil, peaking in 1970 and dropping steadily as easy barrels dried up and the imports rose. Then the game changed in the 2000s and 2010s with the shale revolution. Advances in hydraulic fracturing and horizontal drilling technologies that let us tap some oil and gas that was locked in tight rock. And shale sparked a production boom. U.S. output soared. By 2018, we'd become the world's largest oil producer. Tight oil made up 60% of our total output, and the U.S. was suddenly a global energy force again. But the past decade hasn't been easy. Environmental and societal pressures have pushed for decarbonization and stricter regulations. The COVID-19 pandemic delivered a shock to demand and prices, and the industry has had to adapt quickly. Even so, U.S. oil production rebounded fast, hitting new highs in 2023 with over 13.3 million barrels a day. The Permian Basin remains the star, but even there, companies are squeezing more out of each well, and the easy gains are probably behind us. Offshore, the Gulf of Mexico or America is steady at 1.8 million barrels a day, supported by new projects like Shell's Whale FPU and Chevron's Ballymore tieback. Now let's focus on Chris Wright. His appointment as Secretary of Energy is more than a policy shift. It's a signal boost about what the administration values. Wright's work has been about making American oil and gas more competitive, especially through the service sector. He does not strike me as an old school entrenched oil man, but he founded Pinnacle Technologies in 1992, a company that became instrumental in commercial shale gas production. Pinnacle's hydraulic fracture mapping technology helped launch the shale gas boom in the late 1990s, making it possible to extract oil and gas from rocks that were once considered uneconomic. Wright also chaired Stroud Energy, another early mover in shale, before its sale in 2006. But his biggest impact was with Liberty Energy, which he founded in 2011. And under his leadership, Liberty grew to North America's second largest hydraulic fracturing company, providing completion services and technology that expanded the shale revolution to include both oil and natural gas. Wright led Liberty as CEO until this year when he stepped into the Secretary of Energy role. What sets Wright apart isn't his executive resume, it's his deep, hands-on understanding of the oilfield service sector. He spent decades solving practical challenges that operators face, making completions more efficient, pushing the limits of multi-stage fracturing, and driving relentless operational improvement. He's been a vocal defender of fossil fuels, arguing that oil and gas are essential for global development and American ingenuity, and is against regulation. The key, and then he says that's key to energy security. He served on the boards of companies in nuclear technology and mineral rights, and even on the Denver branch of the Federal Reserve Bank of Kansas City. Wright's leadership is already shaping energy policy. The administration is pushing for expanded drilling and federal land leasing, and sending a clear message that U.S. energy dominance is probably back on the agenda. There's more support for the service sector, more investment in next-generation completion technologies, and a pragmatic approach to the energy transition. But there's another layer to this story, one that goes beyond price charts and policy memos. Our energy potential, especially the ability to invest here at home and bring oil and gas to market, is an international signal for President Trump, and the administration. It's a message that the U.S. will not be held over a barrel by foreign producers as we have been in the past. The fact that we now have capacity to export oil and gas adds a new dimension to our geopolitical negotiations. Our partners and competitors know that American barrels and molecules are available, and they're offering an alternative to less reliable sources. Of course, whether we fully realize this potential is another question. Policy decisions and posturing, market forces, and infrastructure will determine how much of the promise becomes a reality. But the world is watching, and our ability to invest and export is reshaping the global energy checkerboard. Let's break down what this means in practice. First, production dynamics. The U.S. is still posting record output, but the mix is changing. The Permian is plateauing, and companies are focusing on efficiency over expansion. Offshore production is steady, with new projects in the Gulf of Mexico or the Gulf of America providing a stable base. The focus is on operational discipline, getting more out of existing assets rather than chasing growth at any cost. Second, there are policy impacts. On the regulatory side, environmental has shifted, with the administration rolling back some restrictions and supporting more drilling and leasing. Chris Wright's influence is clear: a focus on technological innovation, support for the service sector, and a realistic approach to the energy transition. There's an understanding that oil and gas will remain central to the energy mix for years to come, even as renewables and low-carbon technologies grow. Third, the market's response. Investors are cautious. The era of drill at any cost is over. Companies are consolidating, cutting costs, and deploying capital where it counts. The mega mergers of the past 2 years were about scale and efficiency, not just acreage. With prices holding steady but not soaring, the industry is prioritizing financial health over rapid expansion. And finally, technology. Advances in hydraulic fracturing, stimulations of completions, and new offshore production systems are quietly boosting efficiency. Shell's oil field is using next-gen subsea tech to cut costs and expand field life. Major players are also investing in carbon capture, hydrogen, and renewable gas, not as a pivot away from oil, but as a hedge and to complement. So, what's the FutureWise perspective? Well, I'm not saying that this is the twilight of U.S. oil. I mean, we are seeing a sector that's transforming. We're seeing a sector that's transforming, leaner, more technology that's advancing our practices operationally, and more selective about where and how we invest. The smart money isn't fleeing energy, it's repositioning in energy. Offshore and gas plays look to outperform traditional shale through 2026, especially as policy and capital shift in their favor. Chris Wright's leadership at the Department of Energy makes a decisive turn. Expect a renewable push for U.S. energy dominance with an emphasis on deregulation, innovation, and a pragmatic approach to the energy transition. Wright's background, spanning oil, gas, solar, nuclear, and geothermal, means he's not blind to the need for diversification, but his priority is clear: unleash American resources and let the market decide the winners. As we look ahead, watch for these signals. Are we seeing more capital flow to offshore and LNG infrastructure? Are rigs moving from onshore shale to offshore projects, especially in the Gulf? Who's quietly buying up Gulf service companies? And what does that say about confidence in offshore's future? The energy game rewards those who can see around corners. Right now, the signs point to a sector that's not just surviving, but evolving, setting the stage for a new era of American energy leadership. Mark Roach, FutureWise Energy, trying to keep you ahead of the curve.